record on this computer. All right, I think we are recording. Going to log in on me. Perfect. Well, thank you so much for joining us today. When I was thinking about this presentation, I didn't set the time up front. I had to have a lot of people on the call, but rather thought, hey, let me just record this quick presentation so I can put it on YouTube and share it with everyone who would want to see it. Zoom gives us flexibility to do a lot of those videos. And who doesn't know me, today we'll be talking about real estate market in our region, which is the East Side and Seattle under the coronavirus. Today I have me and Teres Duchnevich with Cross Country Mortgage that will be popping up and sharing his wisdom on where the loan side of the business is, where the funding is, and where the investors are. So two things to mention. I'm not very good at putting slides together when it comes to a beautiful presentation. So I'm a real estate broker first and real estate investor second. So if slides look a little rough, just be with me. I think we've got a golden content for you, and I hope you will enjoy it. So Teres, do you have a few words to share? Say hi.
Yeah, first off, I just wanted to thank you, Igor, for bringing me on today. I know you and I have done business for a couple of years now together. So it's always a pleasure to come out and service you, help you and your family with Cross Country Mortgage. We're always here to help you guys out. So any questions, comments, concerns that you may have, reach out to Igor, reach out to myself. We've been doing this for a while now, and I would consider us specialists in today's marketplace. So thank you, Igor.
Perfect. Well, let's get going. As many of you know, I look at a lot of data and just try to make things as simple as possible. So there is a lot of information out there, and a few things that we will cover are following. So I've got a lot of calls. I have a huge list of clients today that were shopping for real estate, and I've got a good portion giving me a call and say, hey, you know, market is about to crash. I probably want to wait a little bit. It seems like the stock market crashed, and usually the real estate market is lagging behind 6 to 12 months after the stock market. So if stock market crashed today, then in, I don't know, 6 to 12 months from today, the real estate is going to crash. And I've been waiting for it since 2009, because I heard that market crashed in 2009 and it's supposed to crash. So we'll talk a little bit about that. What does it mean and what it looks like. Then we'll look into where the market is today. I've got some latest numbers. We'll go through them briefly without overwhelming you of where the numbers are for the months of April. Did it appreciate? Did it depreciate? Months of inventory, and we'll review those things. Then we'll talk about what is the difference of both recessions. Are we in a recession right now? Absolutely. I'm not going to be just saying, you know, that things are pretty. We are in a recession, and we'll compare, like, what's the difference? Because people remember what happened in 2008, right? That's the one that they, oh wow, real estate market crashed. And they know what happened back then, and they expect the same thing to happen today. So we'll just look into what are the differences between the two. And I'll tell you right now, I'm more optimistic for our region, which is Seattle and Bellevue. We got a strong economy. And I'll tell you, I think it's less likely to crash, and we'll review why. I've got a few slides on that. And also, if the market will crash, what will happen? We'll talk a little bit, what would be the prediction on that topic if that happens. And in the end, we'll touch bases of what are the latest changes in financing industry. So is financing is the same as it was 2 weeks ago? How do investors feel? What loans are in, what loans are out, and what that playing field would work. And before we start, let me just have a look quickly if we don't have anyone else who is looking to join us. Not sure even how to do it anymore. So we'll just move forward. I'll send them the recording. Okay. So what the heck is going on? That's a very good question. I get it a lot. People ask me, oh my God, are people still buying houses? I can't believe it. or someone says, why not? It's a great opportunity. I'm expecting values to drop. So bad news first. You probably have seen this slide before. There was 0 positive articles about the US economy. If you turn on the news, it's all negative. That's the way the news sell advertisement, right? If coronavirus cases are actually not that bad today in some regions, they project them to be really bad in the future, because that's something that that's the way it works, right? So we heard about crazy numbers from unemployment. It's rising. We all have seen the stock market had crashed. Even that over the past 3 weeks, it picked back itself up quite nicely. I don't know how it happens, right? Because the economy doesn't really do very well right now, but stocks are booming. The past 3 days, they've been volatile, but markets are volatile. But, stocks had a huge gain over the past 3 weeks, but they crashed before. And itself, there is the huge uncertainty and people are scared. The reason for that one, no one really knows. On all of the predictions I'll make today or tomorrow, nobody really knows how long the virus will be hanging out around, right? People say that it will be more clear when we'll get a vaccine, and that's probably the only thing that we could know for certain. But at the same time, we should be reopening the Washington state in the next 1 to 2 months, partially. So because of the risk uncertainty, that's a bad news for any kind of markets, because usually people would want to wait and see what happens. So that's the way it is. There are a lot of bad news in news. And the news are so bad that we're talking between how bad it's gonna get, right? We know that we're in recession, hands down. And now we're talking, are we gonna enter a Great Depression? Because of the same factors that I just mentioned. Unemployment is huge, and it will take time to recover. I think all of the growth GDP-wise that we had for the past 4 years is gone. It wiped out, and it will take, I believe it will take a long time. It's not going to be a V type of recovery when we just bounce back. I'm not a chief economist, but I listened to a lot of them in the past few weeks. Everybody has their opinion of this thing. But if you think of any kind of industry, movie industry, you go to a theater and now seats around you will be empty to accommodate social distancing. And you can make these examples in all kind of different industries like travel and so on. So it will take a while to recover, and the faster we get a huge amount of testing needed and the vaccine, the faster we could recover. But it will take time. I don't think that in 1 month when we open restaurants and life will be just back to normal too quickly. So for that reason, there is a concern how long it will take. And some people say it might be a huge depression, not just a recession. And the fun part, recession when your neighbor loses job, depression when you lose your job. That's a depression and recovery when the politicians lose theirs. So let's see what happens. What we know for a fact, the different markets, they will take losses differently, right? Because every industry will take hit in a different way. If you're in Miami, Florida, that a lot of tourists come in, right? It's a very service-heavy industry. We have a lot of folks from abroad, from Europe. That's the first place, right? Miami. Where else do you go? You jump on the plane, you pass Atlantic, you're in Miami. So you know for a fact that it will take massive losses. If you think of Las Vegas, I just had a few friends that went on a road trip and they stopped by Las Vegas. They said it's nothing like nothing they've ever seen. It's a ghost town. So you drive on the street and places are completely closed. There are no people in the streets. It's like a zombie movie. And, there are lights and everything. Some parts are dark and stuff, but it's crazy. We've never seen anything like this. It's completely shut off. So you know that Vegas will take a while to open. You might want to go to your local casino. I'm not sure if you'll be fast to jump on the plane and spend money in Vegas, whatever that will look like. So this market will be harsh. Houston, Texas, energy, and those are just a few examples, but I'm thinking of energy fields. Right now, we use less oil. The price for oil tanked. And there are a lot of liners out there in the sea that are fully maxed out of their capacity to take oil, right? They have problems to store the oil, and they don't have enough. They can't just turn it off and not take oil from the ground, because that's a very expensive process. So I'm pretty sure there are going to be huge layoffs. And this is, if your economy, local economy, dependent on one single resource like oil production, it's going to be really hard for our economy. So how does Seattle look like? And we'll dive in directly in April stats. So with everything that we've been saying, all of the negativity, is there any hope to go from a little boy to a really good looking man? Was there hope for this guy? Let's see what Seattle says. So in quick, April market, I've never thought anything like this. I kind of felt that business slowed down, but business shrinked by 52%. What I mean by that, amount of transactions that we've done in April 2019, right? We had, do I have the exact number in here? We've got 997 transactions we've done in 2019. Amount of transactions we've done in April 2020 was 480. So 52% reduction in transactions. Why did it happen? Well, sellers don't want to put their properties on the market, period, right? It's unsafe. We're in the middle of pandemic. I don't blame them, but they would rather see and wait kind of what happens. And when it's safe to list their properties, they will. So in April, we saw the business shrink by half. Pendings for the week ended on 506 compared to 220 for the weekend, for the week ended 508, or 58% of pendings. So we see amount of activity right now is increasing. The safer that becomes, I don't know if you guys saw it, but I was driving just the other day in the freeway. There are more cars on the freeway today. So on May 5th, starting from May 5th, you could see there were more people maybe in stores. I definitely saw even traffic going down to Renton. So on 405, we see activity is picking up. And we expect the percentage of sales this year versus last year grow slowly week by week, eventually growing to a higher level this year versus the last year. So real estate market, usually people think of a summertime, right? Summer is busy, and it's not really the case. The busiest time for real estate is usually springtime. So starting February all the way to June, July, August is very slow actually, maybe to June. This is the most gaining equity time for real estate. And we're pretty sure that that time will move towards the second half of the year, probably maybe even to third and fourth quarter. As more we open up the economy, we're going to see in the next few months more listings come on the market and more properties listed, and activity is picking up already today and will only increase over the next months or two. So with that being said, for the months of April, what we saw is that buyers that are out there, there are motivated buyers, right? There are very few listings come on the market, and folks are expecting to get a deal, but there are more motivated buyers than listings out there. So we saw 51% of sold properties sold more than the list price, which means that half of the properties that were in the market, we saw multiple offers. And on average, 4% increase in median price over what was asking. So it's not crazy, huge increase in price, right? People maybe don't bid 10% as they did before, but they still go 4% over asking on average of what are the properties came out there. And the interesting fact was that 81% of homes sold with less than 15 days being on the market. Think, that's a really busy market. 15 days in the market and it's sold. I have a friend who just moved here from Las Vegas, and I asked him, well, how long did it take you to sell your property in Las Vegas? 8 months. 8 months, can you believe it? He is blown away when he came here and he says, 15 days, are you kidding me? Like, it just took me 8 months in Vegas to sell the property. So this is where the market is. It's hot right now. It's busy, never mind of all of the crashes and bad news that is out there. April was really busy month. We're gonna see more inventory coming in the market. Right now, the level of inventory is 1.6 months. So we see it slowly increasing. And I think We'll see what happens in the months, but I'm pretty sure that the second half of the year will be busier and busier, and we eventually will get to the level of activity if we had in 2019, depending on how safe that would be to get out there and shop and do all of those things. So you might say, Igor, doesn't make sense. You don't make sense like stock market don't make sense, right? So if there is all of this craziness in the country, how is it possible that our real estate market still has 50% of listings sold over asking price? I'm with you, but it all comes down to industry diversification. There is nothing, no other city in the United States that I would not be more confident as there is, Bellevue, Seattle. We've got a ton of jobs. And I know they also Expedia laying off some people, Boeing laying off people. I get it. I follow this news too. But at the same time, we have one of the giants of tech world are here, Amazon, Microsoft. They're doing just fine. They're doing great. Facebook is still coming up. Google, you see all of these companies that we've got, they're busy and they're still hiring. So with that being said, I want to share, you could look at how important technology is to Seattle. There are a lot of companies, and this is just Seattle. Amazon at 13 million square feet of space, Google at 1.5 million, Facebook, and they're all are coming to Bellevue as well. Amazon will have already 3 towers in downtown Bellevue. Facebook is coming to the new neighborhood. They're building pretty much new neighborhood, Spring District in Bellevue. So all of these companies are coming, and for that reason, our real estate market is staying very strong. This is an interesting fact that was stat that was taken from Labor Department statistics. The national unemployment rate approximately right now is at 18%, and locally around Seattle and Washington, it's at 6%. That says something. I mean, it's still horrible. It was closer to 2% prior COVID-19, but 6% is way better we're doing than national average. So a few more clues on what's going on. From what I saw, when we talk about Microsoft, okay, Microsoft reported a 15% year-over-year increase in revenue and 22% increase in income in its fiscal third quarter, which ended March 31. So they sold a lot of products, a lot of companies. They put their cloud-based service, Azure, they added a ton of people on the subscription model. And those companies, lots of companies were going to take their operations online, and Microsoft was there to provide them solutions. So Microsoft is doing really, really well. The other thing that I see in our marketplace that is remarkable, California developers are keep on buying land in Seattle. So this article came out maybe 2 weeks ago. California development company buys 3-acre property in Soto District for $42 million. So this whole thing will be redeveloped into office buildings. I mean, we're talking about, should I wait maybe to buy a house or not? Well, they came in and spent $42 million to buy 3 acres, and they keep doing so. Here's another one. If you guys been to downtown Kirkland, that new building called Kirkland Urban, you can't miss it. Whenever you enter downtown Kirkland, huge office space that was sold last year to Google for $465 million. So the same developer, they just purchased a 6-acre property near Mercer Island Light Rail Station. So a few blocks from Light Rail Station, they spent $46 million on it. This article was in Seattle Business Journal maybe 2-3 weeks ago. Guess what? They will put another office building in there and probably also will sell to Google. I just don't believe that they will spend $46 million today without knowing or having certainty that they will, have a buyer or someone who they will reposition the property to. So big boys are making moves. I just wanted to highlight it. And another few things that are here. Okay. So does it make sense, Terrace? Does it make sense what I'm going with?
Yeah, 100%.
It all really comes down to supply and demand, right? It's if you see people are buying crazy toilet paper, right? The demand is there. The price for toilet paper goes up. What we're seeing right now, the meat plant, Tyson, right? They said that because of the COVID, they shut down the largest meat producer in our nation. The price for meat, guess what? Will go down because we'll have a very limited demand, right? We've been in Costco the other day. They already say that you can only take no more than 3 packages of meat with you. So there are restrictions on everything, and supply demand, it's the most basic economic rule of what we have around. So far, supply for real estate in our state was very, very limited. I'll save time. There is very limited amount of land, right? We've got water on one side, we've got mountains on another side, so we can't just go anywhere we want. The land is limited, and the housing is limited for many reasons. So with that being said, we so far had a very hot and busy market. So people say, well, wait a second, right? So how does it compare to 2008? And I'll have Terrence jump in here really in a minute. But Igor, well, but market crash in 2008. And what I say to everyone, well, market crash in 2008 because real estate was a fraudulent place to be in. And the reason, it was the mortgage bubble that happened. Today we have a COVID-19 recession. It's a different thing. But in 2008, the cause of the bubble burst was a spike in subprime debt, right? So there was a lot of fraudulent activity on the mortgage side of things. You had really loosened lending practices. So people are photoshopping their income, or you don't even have to verify any income. You could do whatever you want. You could just keep that thing blank, and they will give you a lot of money, and the loan officers, and nobody verified anything. People felt that prices would keep going forever, and people were greedy, right? So it all was moving equity that never existed in the first place, buying 5-6 properties with 0% down on adjustable rates mortgages. With people then realized it probably was a bad idea. Nobody could afford any of those properties, and when the bubble burst, like, folks just lost everything. That's the way it is. When you look back, it makes very clear of why it happened. So this is the slide. We'll talk really quick. I absolutely love this slide. So let's compare of where we are mortgage-wise, numbers back in 2008 and February 2020. So number of active mortgages is about the same. Share of homeowners with less than 10% equity. So what is equity, right? We all know what the equity is. Your down payment is the equity. Amount of money that you physically have in the property is the equity. So share of homeowners with less than with 10% of equity in 2008 was at 14.5%. Now it's a half of that, right? It's a little bit more than a half. So folks have more equity in their properties. Average original credit score back in the day at 708, right now it's 736. So credit scores are greater. Average current credit score, original credit score and current credit score. What's the difference there between original credit score and current credit score?
I think when it comes to FICO, when it comes to credit scores, what we saw before, right, back in the day versus today, especially if you want to touch base, seeing the differences in 2008 and 2020, is with FICO, with verification of employments, with when it comes to actually collecting documentation, there was a lot of greed in 2008. A lot of families, a lot of people would qualify for mortgages that they simply had no business qualifying for. A lot of fraud. So I think even in this chart, I love this chart, how it says, for example, if you're even looking at the subprime loans, mortgages that people should not be getting onto when it comes to qualification with FICO, qualification with how much money they make. There was a lot of fraud back then. In 2012, 2015, we have the Dodd-Frank Act that came out, that Obama came out with, and a lot of different things. So just like you said, man, back in 2008, a lot of dirty money. The main reason why we had a major collapse was there was no systems, no process, no structure on qualifications. Today in 2020, even with the whole COVID going on, people still have to qualify, right? The qualification limits are only getting tighter. And in general, on a broad spectrum of things, right, it's not super easy to qualify for a mortgage today.
Well, and with that being said, we'll come back exactly in the end. We'll talk about what had changed. But I wanted to highlight a few more things. We talk about number of active subprime loans was at a 5,100,000, now under 2. So that had reduced. That increases the security of the market itself. Look at number of active R mortgages at 12 million, almost 13 million to 3 million right now. So it's what, four times less? Could you tell us to our viewer what our mortgage is?
Yeah, so an R mortgage is what's called an adjustable rate mortgage. That's where a bank or an investor or a mortgage company locks in your interest rate, and you're practically paying interest only for either 3 years or 5 years or 7 years. Now, what most people don't realize when they do these ARM loans that many people didn't back in 2008 because there was zero education behind this is you would get locked in on a 5-year. Yes, your payments would be low for 5 years, but then on year number 6, your interest rate completely shifts and changes month to month. You have principal that kicks in, and I'd have families that I reviewed statements on that were on ARM loans before that had payments of, for example, $2,100 that would jump to $5,000 or that would jump to $4,500. And that payment would shift every single month because that interest rate would also change due to the market. So ARM loans are great loan programs for investors, great loan programs if you know you're going to pay off your complete sum of money within 3-5 years. 90% of families should not be on an ARM loan though. So it's important to be educated behind all that.
100%. So what was happening is people cannot afford or qualify for any of it, and they get an extremely, which called teaser rate, right? So they say, hey, you can be paying off right now only $500 a month, right? So they can make $500 a month.
Yeah. So you'd have families that go out in 07, 08, 2006, 7, and 8 that would get these 5/1 ARM loans or these subprime loans, and they would say, hey, your payments are going to be low for 3-5 years. Then you can sell your house. Your house is going to go up in value. But what they didn't realize is you had hundreds of thousands of families that would be in these loans. Then everyone's 5-year mark came up, and everyone puts up their house on the up on the market because they could no longer afford those payments. Then now you have extremely picky sellers because you have a ton of homes on the market and families that can't get their home sold.
Absolutely. Makes total sense. Or they would say, hey, you could refinance in 3 years, right? Because the value will go up, you'll pull cash, you'll be rich. And none of that came through. And here's another one. Our mortgage is scheduled to resend within 3 years from 5 million down to 320. So I just wanted to highlight this slide because I thought it was very different, a very good one to see of what's actually different. And those mortgages are different today than where they were in 2007. So let's move on. What's different? We just talked about strong lending practices, well-being of borrowers. Everything is verified and ensure that borrower can afford the house. The same. How do we ensure for borrower to be able to afford the house? Appraisals, right? Appraisal game was absolutely rigged before. You could ask to write you whatever the number you wanted in the appraisal, but appraisal actually makes sure, they give you the fair estimate of the property to know that you can afford it or not. So all of those practices are in place today. They were not even close in 2008, and that's a big difference of where those two are. So let's move on. I get this question too, besides if market will crash. When homes are going to come on the foreclosure, why should they come on the foreclosure? Let's do this. First of all, what is foreclosure, right? If folks cannot make their payments, they go in today, there is a forbearance, right? So the government stepped out, and there are a lot of changes today than it was in 2008. In 2008,
and I'll talk about that as well.
Yeah,
I'll jump in on that topic.
In 2008, it took them like 9 to 12 months to start to be put in any solutions, right? Today, they were out there in 2 weeks saying, hey, all right, we're going to do stimulus checks. We're going to ban evictions. We will do forbearance. You could delay your mortgage payments. Right now, we see that those a little change. You can then ask for another 180 days and maybe then another 180 days to pay off all of those balances back. So government is really stepping out big time to help those people not to go into foreclosures. Are there going to be some? Absolutely. But a few fun facts, besides that election is coming up and government will save the day. And Terrace, I'll let you talk a little bit more about this. A few fun facts that I didn't put in here. In King County, 45% of homes in King County, 45% of homes have more than 50% of equity. Think about that. Half of homes in King County has more than 50% of equity. So they're very far away from foreclosures. Like the market would have to be bleeding big time for them to, to decrease all of that equity by 50% and then not to have how to pay their mortgage and go in a foreclosure and maybe in a short sale. So folks still have option to refinance. They still have, and we talked about that 6% unemployment in Washington state compared to 18. So they still got the cash, they're employed. Tech workers, they work from home, they still earn their checks. And of course, I'm not delusional. There will be startups, right? Startups that lost their Airbnb, Uber, Lyft, right? Those guys will get unemployed for sure. But guess what? I think that Amazon will hire them, Google will hire them, and those companies will get bigger, like to acquire those talents. And another fun fact, unfortunately, that 70% of unemployed folks that are out there, they are renters, not home buyers. Unfortunately, with all my heart, I give them my heart, because those are hourly workers that usually, earn the least and get squeezed the hardest. Unfortunately, they were not home buyers at all. Like in our median price in the east side of in Bellevue, 800,000. In Seattle, I don't know exact number, but maybe around 700,000. They're just not able to afford it to start with. So I don't see why homes will go into foreclosure. We can make a case that it's all connected, right? Like we all are connected together, and if economy will be taking huge blows, maybe something will happen to Amazon and Microsoft and everyone too. But as of right now, it's been booming. And I think the second half of the year will only get us busier real estate wise, because more listings will come on the market and more buyers are getting back. We see mortgage applications jump. More buyers will go back to the market after the COVID thing is over. So what do you have to add for us, Terrace, on this slide?
I think I want to jump into my portion once I'm up, and I kind of want to talk a little bit about, just touch one more base on the differences between 08 and now, then talk a little bit about forbearance, big banks, small banks, what's going on the lending side, on the money side, and then of course talk about services in regards to the servicing departments that service these mortgages as well.
Okay, so let's do an update with you on FHA, jumbo, refinance, all of that good stuff.
Okay, I can jump into, do you want to flip the screen actually to where you see all of us?
Well, let me do this. Let me just say two more words and then I'll go back to you. So the thing is, guys, economy locally is strong. I wouldn't bet against our economy. You could say, there are things we don't know. We don't know what will happen with the virus. We truly don't. We don't know how long it will last. You could maybe want to wait and see how that will play out. But in our region, like across the country, it's going to be really bad. In our region, I think we will survive just fine. But one thing that I want to point out, if market will crash like it did in 2008, which even during other recessions, real estate market didn't crash. The last recession was real estate related recession, right? We just showed you why, because of those bad loans. But recessions prior, real estate was staying strong. I don't have a slide on that, but there are lots of slides on that. But if it will crash, the one thing that I want you to understand, they're not going to be credit. Tyrus will tell you a little bit in a few minutes of, what are the new restrictions on lending. But today, we already see that lending is getting tied up. So if real estate crashes, it's naive to think that, oh, houses in Bellevue are 50% off. Let me go and do my 3% down payment, low balance loan to get that house because I've got $15,000 in the bank. It's just not going to happen. The rest of the system is not going to work the same, right? Like it's going to be blood on the street, and only the best borrowers with 30 or 40% down payments would be able to take opportunity of those things. So I really wanted to point out on this because we see on the hard money side, investors are pulling money off the table. Terrace will talk of what happens to jumbo, FHA, refinances, and all of those things. But they're not going to be credit. Your real estate is crashing. You're not going to be able to buy anything because no one will give you money. Money will be tied up, banks will be scared, and everybody will be scared. So those are the things that I will finish with. And we went kind of been jumping a little all over the place. But Karis, could you explain them what I just said on how you tell what are the things that are happening right now, and let people see of why I think so. So I'm gonna stop sharing and you can share your screen.
Very good. Okay. I'm just going to keep it at this. I'm going to speak from the heart and just kind of talk to you guys exactly what's going on in general. So Igor, love the way that you touch base on the differences between 08 and 2020. The three main key factors that I noticed when I was doing my research was, number one, cash. There was practically no cash in 08, 09 due to what happened. Today, we have a ton of cash in the marketplace. Second factor is I was reading this article that was talking about how long did a home sit on the market in 08, 09 versus today. I believe the average today, if you're looking at different communities, different markets in general, we're right around 3-4 weeks. Back then, it was 26 months, right? So big difference between homes sitting on the market and where homes are at today when it comes to sales. And of course, the mortgage industry. It was a lot of fraudulent activity happened back then. Today, that's not the case. People that qualify for mortgages or have been qualifying for mortgages since then were required to provide documentation, be employed. Guidelines and regulations got stricter. One thing that I do want to talk about, and I think Igor, you touched this a little bit, was foreclosure ratios or foreclosures. Back in 08, 09, it wasn't something like, hey, I can't make my mortgage payment. I'm going to go sell my house. Okay, I have $50K in equity. My sign went up. Your realtor banged in the sign. Okay, or the bank, your home is going into foreclosure. It's not that simple. To foreclose your property, and I want to touch on this, to foreclose on your property, it's a frugal process. You're going back and forth with the investor. You're going back and forth with the bank. It can take 6, 8, 12, sometimes 16 months for you to actually foreclose on your property. It's a rude process. It's awful. So
well, I don't think it's going to. I mean, as I said, 50% of homes has more than 50% of equity. The other folks has 10% or 20 or 30% of equity, which is still a lot. Think about appreciation rates that we had over the past 2 years.
I'm talking about 2008, right? So in 2008, that's the process, and the foreclosure system and process hasn't really changed when it comes to foreclosing on your home. I like the fact that Seattle, our marketplace, it's an incredible hub. Just like Igor pointed out, 6% of families are unemployed. The rest are still employed. So I'm not too worried about Seattle. But in general, I want to talk a little bit about forbearance. Important for families to understand. Forbearance is not forgiveness, right? If you're able to make your mortgage payment, I encourage you to make it. So what the new Government Safe Act came out with was they're not legally allowed to say no. right? So the government, the U.S. government did a horrible job with this act in educating families on what it means forbearance, how that process looks like, or what it's about. It's not just, hey, you skip 3 months and we're going to tack on those 3 months at the end of your 30-year term or 15-year term. That's not how it works. You're going to have to qualify for that forbearance program after those 3 months are due, right? And they might give you an extra 180 days, an extra few months to figure out the qualification systems, but they're going to scrutinize every borrower, every person. And majority of the cases, families that went into forbearance, it's going to be very, very difficult for them just to simply take those few months and tack it on. That qualification process is going to have to happen. What's interesting is seeing over 30 million families going unemployed as of today, or I believe the other day, we're past the 4 million mark of families not making their mortgage payment. Now, what's important to understand too is this whole process affects banks and credit unions and big banks on the servicing side a lot more than usual. This crushes servicers. So when you have 4 million families not making their mortgage payment, what's important to realize is, for example, Igor, right? He makes a mortgage payment to his servicer, and that servicer makes a payment to the investor. Now, if Igor or I skip our mortgage payment, the servicer is still obligated to pay the investor. Now, servicers are not in the business of stacking a ton of cash. They're simply not. So what's going to happen is in the next 3 to 6 months, families that do take that forbearance program, not qualifying for it up front, it takes time to qualify for that program, they're going to skip their payment. And those servicers are going to be obligated to still pay the investor, right? So they're going to try to make those investment payments. A lot of these servicers, these third-party companies, these mediators, they're going to go out of business. They're going to shut down. They're going to foreclose. We're already seeing that on the secondary mortgage market. So what happens then? If you're going into not making those payments, there will be a bailout. Now, just like in 2008 and 2009, the government did what? They bailed out the big banks. You have B of A, Chase Bank, US Bank, and Wells Fargo. The 4 big banks, there will be a government bailout. Now, Chase across the street from my office already said, unless you have 20% down and a 720 FICO, we don't want you. We don't want you. We're not even going to touch your file. Wells Fargo already said, no, we're no longer servicing or purchasing, jumbo loan products. So
So you're explained it perfectly of how it works. So
yes.
Now tell us already today, right? People say, I want the market to crash. All right, great. I understand what you're saying. Well, but today it's doing great. We have 50% selling for over asking. We talked about those things. But with those servicers not being able to make payments to the investors that provided the money for you to obtain on a loan, tell me what are the changes today? FHA, conventional jumbos. Just tell us today what happened with that being said.
Yeah. So I'm going to touch base on this, right? We'll circle back to that because I want to follow the process of what's heading out, right? So servicers not being able to make the payments, they shut down. There will be a big government bailout. Now, when that happens in general, when you're looking at families that don't make their payments, what the SAFE Act is also doing is they are not explaining properly credit. They're saying that your credit score will not be touched and it won't be damaged. That's 100% false. So this is what happens. When you miss your payment on your FICO score, there was what's called a forbearance missed payment. That's an automatic 90-day late. Now, every single company, every one of your credit card companies, right? So any credit card that you currently have, they do back-end monthly soft pulls. So they're going to keep consistently doing these soft pulls on the back end. That doesn't affect your credit. Now they're going to say, oh, okay, Igor has a 90-day forbearance on, okay, well, it looks like he's going through hard times. We're going to reduce his $10,000 credit card limit down to 5,000. Now, if he's already at 5,000 on that credit card, what happens? Your ratios get screwed up and that automatically damages your credit score. So you're going to see a lot of families that take upon this forbearance. And also important to note that if you have a forbearance on your mortgage, on your FICO, on your credit score, it's going to take years for you to get that rebuild. No bank, no investor will ever lend to you if you have that on your credit. Now, going a little bit back to Igor's question, when all of this happens, you're going to have these big banks with these guideline regulations, shifts and changes, which they're already doing, requiring minimum 20% down, 720 FICO or higher, DTI, debt to income ratios tighter. They want to see that you have a ton of reserves if you're purchasing a jumbo loan, which, let's be honest here, Seattle, Bellevue, that's all jumbo. A lot of our homes are worth $750.
So let's step back. So there are three main financing programs: FHA, conventional, and jumbo. Conventional limit is at what, 765?
Yeah. So FHA, VA, FHA consists of conventional, high balance, and jumbo. Okay. So let's go step by step. So FHA, VA, USDA, these are government loan programs. Every bank and credit union are a little bit different today. We all used to be pretty much the same. We're different. So for example, at my cross-country mortgage, our bank is incredible. We're operating based off of pure cash. We have zero debt. So we're not being as affected as some of these bigger banks or smaller banks or mortgage companies. So for us, minimum FICO score for like an FHA or VA, we're looking right around 620. Okay. And a couple of other factors. Now, conventional loan programs, we work with investors. Yes, we service a lot of our loans, but high balance and jumbo investors, we sell it to the secondary mortgage market. We follow Fannie Mae, Freddie Mac, Ginnie Mae on the Govy side. In general, we're required to, well, not required, but most of the time we sell because we want to recycle our money to keep lending to families.
I get it, Tara. So tell us what the jumbo loan is.
Yeah, so a jumbo loan means if you're borrowing pretty much $740,000 or more from the bank. Now, if you're borrowing that much money or more, so you're going to be required to put a minimum of 20% down. It used to be 15% down, 4 to 6 months of reserves, we pretty much make it happen. Sometimes 10% down. Today, the rules have changed. So larger down payment, larger FICO score too. They want to see that you have a minimum of 720, 745, or sometimes higher. And our pool of investors that purchase those loans from us, we went from 30 to 50 investors. We're down to less than 5. So we have to abide by their rules and their guidelines because they're going to be purchasing those loans from us.
So let me say, guys, for everybody who is listening, this is what I mean, right? So the market is uncertain. It hadn't crashed yet. But amount of investors, right? Because when you go and you say, Tears, give me a loan, right? You take in on the liability and someone invested in you, right? Based on your criteria, they gave you that money, right? So amount of investors on the jumbo side of things, over 750,000, right? They went from 30 to 5. So 6 times reduction in amount of investors because they feel scared. And why wouldn't they be, right? So when market crashes, those investors go to zero. They say, I'm preserving cash. I'm not going to invest. But if I will invest, those regulations that right now the Terra says, down payment already increased, credit score already increased. When market will crash, the down payment would have to be probably 40% for them to give you the money.
Yeah, I would say my average first-time home buyer, second home buyer, they don't have 20% for down payment. So this is my prediction. When things begin or things are already crashed, with this forbearance going on, when these banks change their guidelines because servicers are going out of business, you're going to see families are still going to have to move. They're going to have to buy and sell. People are still going to have to move up and move down. Kids go to college. Babies are being made. So in general, is we're still going to see activity in the Seattle marketplace. The main difference that I predict that's going to happen is with these servicers that are shutting down, the guidelines are going to be stricter. You want to buy a house, you'll need 20% down. Your credit score has to be minimum of 720 to 740. So will the real estate market go down with more inventory? Yeah, you're going to see a shift, right? We're going to be real. You're going to see a slight shift. But to qualify for these programs, these mortgages, it's going to be a lot tougher. So to be in a more cash position is always better. We have programs like FHA. We used to do them all the time. FHA bond loans, 0 down payment assistance. We'd have the sellers pay the closing costs, literally 0 money for a person to go out and purchase their home. Credit score, 650, you're fine. We're going to FHA bond. Today, that no longer exists, right? Investors are not willing to risk simply because we do have over 30 million families going for unemployment, a ton of families going into this mortgage forbearance. And here's the deal. If it comes to paying your mortgage or feeding your family, of course, use common sense, feed your family. Igor, it's funny, I had a cousin of mine that called me, and we're pretty good friends. He goes, "Hey, Terrace, I just got my paperwork for this mortgage forbearance program. I'm good for 3 months." And I'm like, whoa, brother, slow down. I kind of explained to them what it entails. I was like, "Hey, man, do you need me to write you a check? Do you need some money? You need some help?" And he goes, "No, I have cash just sitting in my savings. I have stocks that I can sell, but I just kind of want to take advantage of this program." Guys, in this scenario, the devil's in the details. It's vital for you to understand what you're getting into, because a lot of families, maybe not in Washington, but a lot of families will be forced to pay 4 payments in one, and they will not qualify for those 3 months of payments to be pushed in the back of their loan term. Super vital to understand.
Got it. So I hope between the people that will be watching this, not too many are going to forbearance, but if they know someone, definitely will share this video. So from what we see in short, on the spectrum, on the lower spectrum, I've got very limited amount of money. I want 0% down. I don't exist anymore. Gone. On the higher spectrum, hey, I want to borrow $1 million. All right. It kind of went 6 times reduction in the amount of investors. So we see that tighten up. Any changes on the conventional kind of golden middle side?
Yeah. Conventional, we still want to see that you have a decent credit score. So I can still work with like a 690, 700, 720 FICO score. Interest rates are still historically low. So on ours, our rates are going to range between 3% and 3.5%. On 30-year fixed rate mortgages. On 15, of course, we're going to be lower. Rates are still super low. So that gives families a competitive advantage for qualifications today because their payments are lower, so they're able to afford more house. Changes that we're seeing are mostly in jumbo, high balance loans. We still can work with 5-10% down, no problem. Conventional as well. So rates are low, which is a good thing. For my high balance people, we use a strategy, and this is Igor, something you and I can talk about off screen, is what's called a first and a second. It's you don't put 20% down, you still qualify for more. You just get 2 loans, one big loan, then a smaller loan on top of that.
Gotcha.
Your payments are slightly higher, but you qualify.
Got it. We'll touch really quick and we'll wrap up. We'll wrap up on what also you see on cash refinance and HELOCs, because I know that HELOCs has been kind of dried up as well.
Really good question. So I personally do not do HELOCs, but I do a ton of refinances and cash out refinances. So on the HELOC and cash out refinance sector, investors are very iffy on, they're a lot more skeptical, say, to actually allow families to pull cash out when it comes to their current real estate. So unless you have like an 80 or a 75% loan to value, meaning you own most of your home or you own 50% of your property, you're not able to pull as much out as you used to before. And if you still want to, they're going to give you a higher premium. You're going to have a higher interest rate. It's going to be at a slightly higher cost because they're going to do whatever they can to make their money on the front end, because a lot of, again, these servicers are losing a ton of money on the back end.
Gotcha. This is perfect. I think we touched pretty much on everything. I'll just go back to my slides and we'll wrap up in here. I don't think that we've got much left to talk about. So yeah, guys, that's exactly what I mean. Market had shifted, right? Market being volatile. We'll already see market reacted. Investors pull their money out. It's still, you can go and get a loan today and interest rates are amazing. But for those that have been telling me, oh my God, I can't wait for market to crash, really think of what you wish for, because I don't want it to crash. Crashing market means people go hungry, there are strikes on the streets. I mean, it's dirty. You don't want it to happen. And then in our
It took
region,
us years.
what?
Yeah, it took us years to build a beautiful real estate market after what happened in 08, 09. We have a beautiful market right now. Real estate is good. Homes are good. Values are accurate. Guys, we do not want real estate to go down. We simply don't.
We don't. And because of there is real money out there, there is real equity, and because of unemployment in our local market is so low, and all of those things, the economy, you know, all of those companies are here. I would predict the next 5-6 months be actually busy. I think when the stay home order is lifted, and people go somehow back to work and start enjoying outside activities more, go see more tours, more properties, when it will feel safer, I think we'll have a busy second half of the year. So far it's been busy, and I would expect it to be this way. Maybe there are some things that we didn't see right now. If I would see news of, you know, Amazon's not coming to Bellevue, I would be the first one to let you guys know. But for right now, it's looking pretty good. So we touch on update on financing. Thank you, Terrace. The two responses you could have right now: sit and wait. I think it's a loser response. You know, you can be frozen to wait while others take an action, or you can think and act. What do you think? Respond with curiosity and action. That's something that we do all the time, and that's something I truly believe in. So what you can do: become educated, learn. Right now, this is the time to reach out, ask questions. If you get cash, if you own the property, get liquid. You might want to refinance, pull some of that equity out. Maybe look for another property, maybe investment property. Maybe this is your first property you're buying. If there is no 0% down, there is still 3% down. There is still 5% down conventional loans. And those interest rates are amazing right now. Terrace, what is the current interest rate right now?
Rates right now, if you're looking on a 30-year fixed rate mortgage and you have good credit, good DTI, they're going to vary because they're jumping around. We're anywhere between 3.125 and 3.5, which is incredible. I mean, even last year we were anywhere between 4.25% and 5%. And today, seeing how we're down more than 1.5%, it's just remarkable.
Gotcha. Amazing rates, guys. So, you know, with that being said, personal residency, I'm moving out of this year, most likely. I think this will be a good time for us because we just got a baby. She will grow a little bit. It will be easier for us to make a move because right now I just can't think about it, but we'll get there. Investment properties, you know, if they will keep printing money, inflation, it's amazing for real estate, because if you lock in at the low at the low interest rate, any property today, down the future, you'll have cheaper dollars to pay it off with. So inflation is actually very good for real estate. And if you think that the market will go down and we're going to enter a disaster, then sell it all and we'll help you with it as well. So with that being said, I know that we have our friend Amit on this webinar. Amit, if you have any questions, you're more than welcome to ask, but I'm gonna stop the recording. And thank you so much. This is our contact information to find us. And let me see how to stop this thing.